Have you ever felt totally overwhelmed by the idea of knowing where to start when it comes to investing, or maybe feeling like you need an absolute degree to get going? You're definitely not alone. But in today's video, I really want to talk about ETFs, standing for Exchange Traded Funds. It's a great place where many beginners and long-term investors start out because they're super simple, easy to use, and low cost. What's there not to love? So what are ETFs? Well, ETF stands for Exchange Traded Fund, and they're basically a basket of investment that track some sort of index. They're a type of index fund, if you've heard of them. Exchange Traded Funds, though, crucially, as I say, track one of those indexes in a way that is relatively cost efficient. Now, when we're talking about indexes, they're basically just a list of a certain sector of the market. So you might have heard of, for example, the S&P 500, which is a list of the 500 biggest companies in the US. The FTSE 100 is a list of the 100 biggest companies in the UK. The Stoxx 600, you might have guessed it, a list of the 600 biggest companies in the wider Eurozone. Now, these are all examples of indexes. What an ETF does is it buys all of the companies on that list via their stocks, and it holds them in a little basket just for you. So when you buy an ETF, you're buying a tiny little bit of all of the companies that are in that list. And what that means is that you get instant diversification. So you get access to a whole load of stocks that you as an individual might not otherwise be able to introduce into your portfolio. And for beginners and long-term investors, this is golden. So ETFs only really took off in the late kind of 90s in the US. They're a relatively new thing when it comes to investing, which is why you might not have heard of them from grandparents, parents, or otherwise. But they've absolutely boomed since they first came about, because they solved one major problem when investors came to look at what to pick. So why are they so popular? Well, number one is that they are so simple. You get access to a broad section of a market, you don't need to research individual stocks, and you pretty much know what you're going to get from just the title. The second reason why they're so popular is because they're cheap. Actively managed funds, where there's a fund manager, a person, a team of people who are in charge of picking the individual investments that go inside, are generally more expensive because you're paying for knowledge and active oversight of those investments. ETFs are passive. They're simply setting up an algorithm to follow that list. And that means that they can be really, really cheap. And that means that they can come in costing less than 1% most of the time. For investors, this means that they keep their management costs and therefore their growth and performance potentially higher as well. And the third reason why they're so popular is because they perform well. Generally, they perform in line with the markets. Now, of course, if the markets are going up, then generally so are ETFs. And of course, if markets are coming down, generally so are the ETFs that are following it. But there's lots of arguments to suggest that actually just tracking the market will almost always outperform active management, aka a human trying to decipher what they think is going to beat the market. I'll do a whole other video on this because it's a really niche topic and I love to get into it. But it's more focused on how and why market mechanisms move. But for today, we're just focusing on why ETF. One big question you might have at this point is, though, will ETFs, that passive management, outperform what active managers can do, where you're looking at potentially what you believe to be the best investments in the best quantities to try and beat the overall market? Well, the stats are relatively clear to me, at least on this front. The research carried out by many different outlets suggests that active management doesn't outperform the market in the long run. One of the main reasons for this that they argue is that actually the market is self-correcting. So behind the scenes, naturally the best companies will rise to the top of the indexes and will fill up the most spots. When you're trying to actively pick it, you'll always miss bits. Sometimes arrogance gets in the way. And as I say, those natural mechanisms that run behind the scenes in the economy and the markets are usually the main argument for why Passive investing will always be active investing. Now, it's subject to opinion, and everyone will have their own opinions on it. And of course, there will always be examples of where active has outperformed passive. This is just one side of it, but the stats, for me at least, certainly tell a very clear tale. So are they a little bit too good to be true? It's almost like, what is the catch? Because there are catches, of course. The first one being related to that performance is that they don't outperform. They're not going to set your world on fire and do way better than the market. They're only ever going to match the market. So don't expect anything more. I've talked a bit in today's video about broader market ETFs as well, so the likes of the S&P 500 or the FTSE 100. But actually there are ETFs out there that can focus on really niche sectors and not necessarily have that many investments within their portfolio, or indeed invest into a broad basket. What this can mean is that they can be quite high risk and potentially more expensive as well, depending on what they're focusing on. So don't be sucked into the idea that just because it says ETF on the tin, it's always super cheap and super simple. Double check what is going into it and what they're investing into as well. And some ETFs will be what we call leveraged. You might be able to see this from the title, where it will say something like hedged, for example. This will tell you that in that ETF, they're using specific financial instruments to make sure that they match the market performance, to make sure that they even out things like currency fluctuations, and to do various other mechanisms behind the scenes to try and balance out the performance. This isn't necessarily a bad thing, but always make sure that you understand it. It might be one, for example, that beginners want to avoid because it just feels like a little bit too much. If you're unsure, you can always check the fact sheet, sometimes called the key information document, which attaches onto different ETFs. This should give you more of an overview as to what is going into it and how it works. Whilst many opt for ETFs over individual stocks because there's less research and less risk involved, you do have to still be aware that there can be ups and downs. It's not a magic solution to it being always growth or always sunny days. As I say, when the markets are up, generally ETFs are too, but that can also go the other way and go down as well. So here's how you can get started in 3 simple steps. First up, it's about choosing your theme. Try and choose, if you're a total beginner, something nice and broad. You might start with a home index, you might start with one of the big famous ones, the US, the UK, Europe. Start with something that you're relatively familiar with and you can understand from the off. The next step is all about picking your provider. When you look within your investing platform or whatever that might be, you'll probably see lots of different of the same ETF and be thinking, oh my gosh, why are there so many? The good news is that what is in the majority of them will be always identical because they're all following the same index. However, what might be different are things like their fees. So check this out. They might also be slightly different in the way that they replicate the market. So if you imagine stocks are changing in value every second of the day, some ETFs will seek to exactly replicate this. Some will keep their costs down a little bit and they'll only rebalance once a week, for example. Now, what this means is that your ETF might not perform exactly as the market's performing, but it'll be slightly lower cost. Others, as mentioned as well, will also use other tools, such as more complex financial instruments to hedge. This could again alter those cost ratios. Cheapest isn't always best. I often try and look at the size of the fund as well to get a gauge for how popular it is and how cost effective it is compared to others. Now, the third step you want to think about is automating that investing. When it comes to ETF investing and wider market investing, generally what we see is that little and often really helps to boost that overall growth in the long run. Now, I'd absolutely love to hear from you in the comments. What is one thing that you're going to do after this video to get started on your ETF journey? Is it actually just picking one investment? Is it looking at the costs? Let me know. And do make sure that you like and subscribe if you're enjoying these videos. Do give me any ideas of videos that you want to see in future. I hope you're enjoying this channel and I'll see you all soon. Bye for now.